Ladies and gentlemen, I am Flexibility, and right now you are seeing the daily time frame. I am going to explain to you the relationship between the daily time frame and liquidity sweep. So pay very close attention. So first of all, right now we are on a daily time frame. Okay, each candle represents 1 day, 24 hours in a day. So that's 1 day, 1 day, 1 day. Okay, the blue candles are the bullish candles, and the black candles are the bearish candles. Blue candle means that the price is going up. Black means the price is going down. So what do we have here? We have a bearish candle followed by a bullish candle and then another bullish candle. This three candles is a three inside out candlestick formation. So as soon as this third candle closed above the open of this first candle, this became our demand zone area. Now, because we're on a daily time frame, this actually became a major demand zone area. So 1, 2, 3, that's our demand zone. This big rectangle is our major demand zone area. Okay, whenever we have demand, that means that the price is going to, that means that the buyers are prepared to push the price to the upside from this level, going upwards, going upwards, going upwards. Within this rectangular box, we have buying pressure. Buying pressure means that the buyers are prepared to push the price up. Another confirmation is that around this level, this is where we had the wick rejection. This is where the bullish candle closed. That's where the next day opened. This rejection area right here, if we draw a line going towards the future, we had a body break. Okay, so this demand zone went to the upside and broke this level. Okay, we have a swing high around here. The swing high was not taken. However, the body break is sufficient in order to justify this zone being a solid zone. Okay, solid zone means that this demand zone area means business. So now, as soon as this candle closed above this candle's open, that formed a demand zone. On this day, the price opened right here and it wicked into the demand zone area, and we had a reaction. Both the buyers and the sellers were equal. This is the reason why you have a cross. Okay, the second day, the price opened right here and it came down into the demand zone again, and we had a strong move to the upside. This whole day, the buyers took control of the market. Now, in the next day, we had price open around here. This is the candle open, bearish candle. Black means that the price is going down. So right here, the price came down. Okay, so nothing to see down there. So now, pay attention to what happened around here. Over the past 1, 2, 3 days prior to this day, okay, we had a liquidity accumulation. What does that mean? Is that each of these day lows has loads of volume. What does that mean? That means that there are loads of traders all over the world placing their stop losses around this level, around this level, and around this level. Okay, and the algorithm of the market makers knows exactly this. The algorithm of the market makers knows this. Okay, so what happens on this day? Instead of the price just going to the upside, okay, what does it do? It specifically goes down below into this major demand zone area. Now, price going downwards, it actually sweeps all the stop losses that are resting around this level, and this level. Pay attention. 3 days, this one tiny wick swept all the liquidity around here, every single stop loss around this level, and that level. So this wick from this candle is actually called the liquidity sweep. Whenever you see this happen, it's never by accident. It is actually a very calculated move that happens in the Forex market on all time frames, from the daily to monthly to weekly to hourly to the 5-minute time frame. It happens on all time frames. But why does it happen? It happens because the people who move the market, which are the big banks, they need to justify their big moves. And in order to justify their big moves, they need to have somebody to trade against them. Because they're pushing such high volumes, there's nobody in the market who can match their trading positions. So what do? They accumulate liquidity, they engineer price action, and then when there's a lot of people who have placed stop losses around certain levels within the market, then they take it out and then they can push the price to the upside. The market is manipulated. However, that doesn't mean that meaning you can't make loads of money in the Forex market. So this move right here, which I have marked out with this white arrow, is the liquidity sweep. Okay, and I specialize in teaching people how to master the liquidity sweep within the Forex market. So from here, the price moved upwards in a very impulsive move, and that concludes this session. Do not forget to join, like, comment, and subscribe, and I'll see you guys in the next one. Take care.